Spotify reported earnings before the market opened on Tuesday, and let me tell you, the market's reaction is a little bit crazy. Stock is up about 15% as I'm recording. Now, I thought results were good, but I thought there were some weaknesses. So when I read the report this morning, I wasn't quite sure how the market was going to react. Obviously, the market is focusing on the bottom line and margins. So I'm going to get to exactly what I mean by that and where there was a little bit of weakness in the quarter. But it seems like the focus is not on those weak points. It's on the stronger points from the quarter. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get right to the report and give the highlights. This is the executive summary. This is kind of the first page you should always look at in a Spotify earnings report. The first thing to focus on is user growth. 615 million monthly active users in the first quarter. This was actually a little bit below Spotify's own guidance of about 618 million users. They talked a lot about this on the conference call, but basically some cost cuts that they made in 2023 on the marketing side were starting to impact the user growth in early 2024. So that's why we're starting to see growth go from 25% to 19%. On the premium side, 14% growth in premium users. So obviously there's more growth on the monthly active user side. That is in part because Spotify's growth is primarily in developing countries. So not all that surprising. And this is a trend that we have seen long term. But I was wondering whether this was going to be a focus for the market. I don't think it's that big a deal. But sometimes when you miss on a number like this, investors really hone in on it. But keep in mind, 19%, 20% growth, if you can do that each year, year after year, you are going to have a phenomenally large business over the course of a decade. Compounding growth at 20% for 10 years, that's kind of the duration that I like to think about. You're going to be 6 times bigger than you were. So probably not even the ability to grow at a 20% rate from 600 million over the next decade. So that growth rate is going to have to come down, but just wanted to note that this is still really a phenomenal growth rate given the scale. So from a financial standpoint, we did have 20% growth on the premium side. This is partly because of price increases. They're slowly ratcheting that up around the world, different paces in different spaces. And then an 18% increase in ad-supported revenue. This is where I would like to see revenue growing faster. But again, if you can grow 20% a year for a decade, suddenly this gets to be a really big business. So this is the long-term trajectory that I want to see. What I was very impressed with is gross margins, 27.6%. I believe they said this is the highest they've ever had at Spotify. They were also operating income positive, $168 million, and generated $207 million worth of free cash flow. So very strong results across the board. And obviously the market is really focused on this margin number and also operating income and free cash flow. So let's dig into some drivers there. I think this gross margin chart really shows why investors were so impressed with the trajectory of Spotify's margins. 27.6% for total gross margin, 30.2%. So you're in excess of 30% on the premium side of the business. This is where Spotify would like to be long-term, thinks it can eventually be over 30%, but has never actually consistently shown the ability to do that. So we're starting to see that things like bundling together of audiobooks and music are starting to push those margins maybe a little bit higher. So it will be interesting to see if Spotify can get to a 30 to 35% gross margin, maybe at kind of the peak. But that's really what investors were looking at today. Ad-supported gross margin, 6.4%. Again, moving in the right direction, but not at the scale that you necessarily want to see. This was really the improvement on the bottom line, and with operating income is operating expenses declining 9% year over year. This is the result of a couple of rounds of layoffs that the company's had over the last 12 to 18 months and just a real focus on efficiency for Spotify. So this is something that we've kind of known was coming, but we're starting to see those actions become impacts on the financial statements. So the strategy is turning to evidence that the strategy is working. That's really the broader takeaway. Free cash flow, you see a similar chart where it is like the recent numbers are kind of off the charts historically. Historically, free cash flow has been kind of bumping around 200 to 300 million euros. And now suddenly over the last 12 months, you're getting closer to €1 billion. This is where I talked about where growth exists. This is the total monthly active users, and most of the growth right now is happening in what they call the rest of the world. So not Europe, North America, or Latin America, places in Asia, Africa. That's where they're seeing most of their growth. And that's why you're not getting the same revenue per user as you were when you were growing in places like the US and Europe. Premium subscribers also dominated by the US and Europe. Again, not a huge surprise there, but just wanted to highlight the numbers historically. For the second quarter, this is where we're going to see more of the same, it looks like. Total monthly active users expected to be 631 million, premium subscribers 245 million, and gross margin increasing again to 28.1%. So it looks like the momentum that we have on the top line, on the monthly active user side, and then controlling costs are going to continue throughout 2024. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, I think the momentum that we've seen on both the revenue side and also the expense side is probably sustainable for Spotify. So I think everything's moving in the right direction. And if that was all there was to the company, that would be great. But what I was really interested in on the conference call is what they talked about expanding into in the future. So they have obviously added audiobooks recently to some of their premium bundles. Daniel Ek also talked about moving into things like education. And this is where when you build a platform like this and when you're an aggregator of demand, when you're pulling in consumers who want to listen to things, you're finding all kinds of new use cases for your products. And what he said was when we added these premium subscriptions to podcasts, one of the things that users were doing were creating courses, educational content. So that's a new avenue for them to potentially grow the business. Not just in an audio sense, and this is where they've been testing a lot of video on Spotify. If you are a Spotify user, you probably noticed that certain podcasts just include video that just automatically plays. There's also video with some of their advertisements. So this is another avenue for them to grow the business. You could potentially do things like educational content where you can either listen to it or you can do video. You can maybe even interact with creators on their creator page. Again, Spotify is creating the tools to be the content hub if you're a creator. So that's really where you want to be as a platform, is you want to be the preferred place for both supply and demand, because that's what gives you power as the aggregator in the middle of those two. So I love the positioning that Spotify is in. We've seen them start to dominate the music business and really take control of that as some of their competitors kind of fall by the wayside. That then translates into success in podcasts, success in audiobooks, and now potentially success in things like education and video. So lots of great opportunities for growth in Spotify long-term. And if they can control their costs, this could be a phenomenal performing stock from a financial perspective as well, which they typically haven't been throughout their history. So I loved what I saw from the quarter. I would love to see those monthly active users number grow a little bit quicker. I would love to see the advertising business do a little bit better. But for right now, not a lot to complain about. And shares are up, like I said, about 15% as I'm recording. So what do you think about the results from Spotify? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.